Good evening, guys. Today is Sunday, March 9th, and we're gonna talk about market and our position in our portfolio, what happened last week. Well, you can see this is a chart of ES futures and VIX. Probably it's the most volatile week which at least we witnessed during our Discord service. Each day during this week, swings from low to high was up to 200 points, but not less than 100 points each day. And volatility for sure increase from about below 20 on last Friday, and we finish week with 23.5, but we went up to 26 plus. Yes, it was big challenge for our account. Luckily, we had good timing during market bounce up, and we closed couple of our positions with good profit. It was, I believe, V8 at least, and we did some adjustments. We will talk about that. Right about market, so it was dropped just for this week more than 200 points, and it was even lower on Friday. We went down more than 300 points for the week, and it is how many points altogether from our top. Well, it's approximately 500 points down market, and volatility increased from approximately 15 to 25. So very challenging environment, and welcome to new reality. What we have to adjust in our strategies. Probably we have to reduce our margin used, because in this kind of events, margin is probably the most valuable asset for us. We need excessive margin to do adjustments for our position, and probably gonna reduce amount of naked puts and switch more to strategies which has the less amount of naked puts compared to the long puts which we use in our hedges. For example, Kazoo small is a good example, because we have for each short we have one long, or it could be balalaika also, because for balalaika we use two longs also, and four shorts. Violin is also pretty good, because it's little bit less. Yes, it's need little bit more margin compared to other strategies, but it's a little bit less volatile from a P&L point of view. So let's go and see our positions now. So this is OptionNet Explorer. It shows total our position in ES futures, but we will talk about each of them separately for sure. So first, let's go and check our balalaika trade. This is how it's look like. We did an adjustment. We roll our short put out to 70 days. The closest one right now is 28 days, and it is at delta 9.2. not bad. It was also rolled down during this week. And the second one, which we roll just on Friday, is right now at delta. Sorry, just a sec. Cannot find it. Oh, sorry, it's 54 days till expiration where we roll it, and it is right now at delta 10.4. Also in good condition, pretty far away, but you know it became pretty good after market bounce up from the bottom on Friday. So if we're gonna go down again and break that low and go even lower, our probably position will be again under pressure. But we have some still left some protections here. We have one long, one of them we spent already for all, one long put, and 1, 2, 3, and 3 verticals, which we can continuously use if we need to finance our rolling of short puts. Next, let's talk about our income positions. So income one, it also was rolled, and by the way, if you remember, we had some verticals from ladder strategy, remaining verticals which we hold, and we used them this week and previous week to do rolls of our income positions. Right now we have income one 28 days till expiration at delta 12.4, but again it's after a bounce up from the bottom, so if we're gonna go down it's probably gonna need to be rolled again, but I hope not. So we will see how it's gonna play. It's not too many days left, 28. If market will go down, we need probably to roll it not just down but also out. Income 2 position is at delta 12 right now. It's 35 days till expiration. The same thing, if it's gonna be under pressure again, we will roll it down and try to find a way to finance this roll. And income 3, it is 70 days till expiration. This position was rolled out without any using hedge, just because we did roll it out. We could pay completely. It was a zero debit roll. Right now it's at delta 9.3, pretty far, and I hope we don't need to touch it for some time, even if market continue to decline. If we talk about our CDHs, it was a couple of questions about them in Discord channel. Yes, guys, don't forget that we opened that CDHs with zero cost. Unfortunately, we didn't have chance to improve them. We just did, I believe, just one CDH1, which we roll 100 points vertical, and now it's more or less sufficient hedge. This one CDH1. You can see that right now we have 550 points wide spread, and delta is pretty good, -9. So, and of course this hedge is in profit, not too much. After market bounce up, it's get $760, but it was close to 2000. So this CDH for sure we're gonna use next week if we need to finance our next rolls. So, but unfortunately, our other CDHs we didn't improve, and they're not sufficient hedges. They're not in risk for sure. We don't get any trouble from them. We will continue to hold, but you can see we have -6 delta. It's for two of them. So each of them it's just -3 delta. So it's not sufficient hedge. But again, we don't need to worry about them. At least they're not in trouble, and with big market decline, it's still gonna help us somehow. How we're gonna use them? Probably, if we have to, we probably need to close them with small profit, and use that credit to finance our roll. But we don't need to touch them right now. This is how it's look like. What else we have? We have Kazoo strategy. Kazoo 2 and Kazoo 1 we closed. Kazoo 2 we closed this week with good profit, approximately, I don't know, so it's not good profit, but it was some profit. Kazoo 1 was closed last week, I believe, and it also was profitable. But all of this right now under attack for sure. We did some adjustments. If you remember that strategy which I introduced, it was the idea to simplify it and not roll any short puts or hedges, just close them if they reach delta 20. But unfortunately, because we don't have too many available expirations more than 60 days, I wouldn't like to roll all of them at the same expiration, so we just break that rule and just did adjustment, roll down our naked puts and the hedge to make it safer. So right now it's let's see, Kazoo 3. This is how it's look like. By the way, that dots it show how it's look like during the Friday from low to high. Right now it's a delta just 1.4. It's not big deal. Our naked put at delta 10, so should be okay. I doubt that we're gonna make any money from this trade, but at least we will play to break even. I hope that nothing gonna happen and volatility will not increase from here even more. I think in a week or so we will reach that close to zero loss position point, and we will probably close this. It's Kazoo 3 small. Kazoo 3 big is looks a little bit better. It's still minus $450 right now, but it looks better because it still gives us a chance, if everything gonna be okay, to be in profit with this position. You can see it from the graph. I hope we will get some profit from it. Kazoo 4. Kazoo 4 is a 54 days till expiration. We have our shorts at delta 14.6, pretty high. If we go down, probably we have to roll it again, but it still also have a chance. If market normalized, we will make money from it. It's definitely good trades, and you see that it's not very volatile even in this kind of market environment. Kazoo 4 small also looks the same. It's small loss, about $180 right now. It's also 54 days. and same delta 14.6. That's how it's look like. And Kazoo 5, which was open just this week, it's Kazoo 5 small. It's in profit, small profit, about $100. Also 54 days till expiration. And because we roll them, it's right now at delta 8.3, very safe. Hope at least this one will be profitable for sure. And Kazoo 5 big is right now also in small profit, $280. And same 54 days till expiration, and delta of short puts about 9.3. So not too bad. I don't worry about right now Kazoo 5 position. Kazoo 3, it's a little bit underwater, and the most important thing, it's hard to get profit from it. Probably we're gonna play it till we'll get at break even. Especially Kazoo 3 small. That's how it's look like. But not too bad. Our portfolio looks like it's not bad shape, especially after market bounce up. So also we have a couple of violin positions. Again, we close violin 8 with good profit, more than $1,000. Now we have violin 9, which is in loss approximately $570, but it's very safe. I hope it will be okay. Our short delta at naked puts at delta 9.2, 28 days left. So if nothing serious happen again, I think that next week we will go back to profit with this position. And V10, which we open right after we close V8, it is in profit right now, about $360 after on Friday market bounce. But it's just new position, 70 days till expiration. We will see what we're gonna get here. But after bounce up, it's very good delta, just 7. And again, don't forget our volatility is very high. If volatility will normalize and go at least to 20 or below, it will help also. All our naked puts delta will be reduced because of that. We also believe have our D position still, which left. Let's see how it's look like. I believe we roll it to 49 DTE. Yes, 49 DTE. Our shorts right now at delta 14. We still have 2 verticals as a protection, which one of them is just 14 days left. I even don't know if we can use it or not. But another one at 115 days till expiration. Let's see where it is. Well, it's in pretty good delta 13, so it's very expensive one. So if we need it, we will use it to roll down even more our naked puts. But in this case, we will stay without hedges anymore. But it's still fine. This is why we use that, open that hedges. We have to use them. Use them to pay for our rolls. You can see that position itself is not bad. If we go to up to 25th of April, this is how it's look like structure. So I think that we can handle it without big problems this time. That's it for ES. Let's go and see our MES positions. We also did on Friday, I believe, we did roll. We rolled down our longs. They were way in the money. Use that credit to roll 3 of our naked puts also down. So if we open both of them, I mean both expiration at the same time, you can see that we are in very good shape. We still in good profit, approximately $546. And this is reason why I didn't close that profitable short-term trade. I just opened this one. This one is just 14 days till expiration. Can you see that it is protecting our other expiration? Because if we are above tail profit, but if market continue to go down, this structure will make money for us. You can see it has pretty big negative delta, 14.6. So the second one, if it will be under attack, the first one will help us to protect it a little. So what we have here, this one is 54 days till expiration. After roll down, we have 2 longs, one of them at delta 32, another one at delta 29, which do pretty well protection of our shorts. We have one short at delta 20. That short, I will remind you, we will be ready to be assigned because it's will strategy, and we should at least mentally be ready to be assigned with this strategy. But other 2 strikes, which is 3 of them, 3 naked puts at delta approximately 14 now, and another one at delta 11.6, this one which we roll down. So that's how it's look like. If market continue to go down, we will do the same thing. We will get our highest long, roll it down, and use that credit to roll down our closest naked puts, 3 of them. But we're not going to touch this one naked put. We will be ready to be assigned if it's necessary. If market will collapse below the strike in 54 days, we will be ready to be assigned with one contract. What else do we have? We have TLT position. No, let's talk about oil, because oil went down so much. You see that we were open that position when oil was at 73. Right now it's at 66. It's huge drop down for oil, but our position is not bad. We also did a roll, same way. We rolled down our long, which was in the money. So we roll it down to strike 63 and use that to roll down our naked puts 2 to 3. We at 58 strikes we close 2 shorts and open 3 shorts at 55. So this is how it's look like now. Also, guys, because it's a wheel strategy, we should be ready to be assigned, and we will be assigned with this one at strike 58, but just one contract. These 3 we will continuously to roll down by rolling down our long. So I hope it won't happen, because we are pretty far. I doubt that oil will go so low. It need to be a huge decline, which well below the price of production for shale oil. So I hope it won't drop this much. But who knows? It could drop at least temporarily, and we need to be ready for that. TLT is in beautiful shape. We are approaching the maximum profit, Right now it's 1100, more than 1100 in plus. The closest our expirations just 14 days. We will wait and probably till expiration, and some of them will be in the money and we will roll it out. We have two short calls at strike 90 and two short calls, short puts at strike 90. So some of them will be in the money for sure, but we will handle this. Also, guys, I did open, some positions in stocks. I wouldn't like to discuss it right now before I publish that course, which I hope we are gonna do it next week. This week was pretty busy for me. Didn't have time to think how to organize that course. Actually, I already know how it's gonna look like, but need just to finish it. I just would like to say that all that stocks except two positions in pretty good condition. Two stocks, one of them it's XOP, was a huge drop down, more than 20%. And the reason for that, it's a big decline of oil price. We did some adjustment. I hope that we will handle it because it's ETF, so I don't expect more decline of that position. So we did some roll downs and waiting for bounce up. I think it's a little bit. It dropped too much and need to be bounce up. And another one, it's Amazon. Also, it was pretty big decline. We did also some adjustments, I believe, on Friday. So after the course, when you will be familiar with all adjustments which I do, we will discuss it here. And also it's not very convenient because in OptionNet Explorer it's not convenient to use stocks. For some reason, I don't know, they claiming that this version is a better version for futures, but looks like stocks work even worse than futures. For some reason it's not updating prices correctly all the time. So we will see. Probably we will analyze it in a different platform. That's it for our position. Let's talk about questions. It was some questions this week for sure, because I understand you're nervous. Market is behaving unusual way. So the first question, please explain your goat move. Okay, first of all, guys, I have a pretty big account and my total naked puts was more than 30. So I decided, when I see what happened, I decided to reduce amount of naked puts. And how I did it, let me show you. No, sorry, it's not this one. Here. So it was I believe it was 10 naked puts at Delta 20 when it was time to reduce, to roll them, because it was at Delta 20. I decided to do it this way. I'll show you as a new position. So it was approximately, I don't remember, 35 days or 38 days, it doesn't matter. So what I did, let's say that it is 5600, so at delta more than 20, I close 5 and went to approximately 60 DTE, right now it's 54, and sell at the money to naked puts. You can say, wow, you go to high, you go to at the money. But guys, in this kind of high volatility environment, at the money puts extremely expensive. Can you see it's even right now, it's $135 just for each of them, which is very good. And see at that structure itself, if market continue to go down, it will perform much better than it was with 5 shorts. And if market bounce up, I don't risk anything. So it's good move. First of all, for 3 reasons. You see it's delta 12. It means that I reduce my positive delta. Second, I reduce margin a lot because it was a 5 short puts. Now it's just 2. And third, I reduce a lot my Vega risk because we don't know. Even we have Vega hedges, so I wouldn't like to meet this kind of and test that situation again, what happened in August. So I decided to reduce amount of naked puts. And I did one more thing. I'll show you. After I move them at the money, I also sell one call also at the money. I'll show you. Here it is. By the way, I open short calls at the money again for huge amount of money. It was approximately $150 cost. But when market went down on Friday, I closed it just for $40. So I made profit from that call more than 100 points. And when market bounced up again, I reopen it again. So right now I have approximately here 4 naked puts and 1 naked calls. And structure look like this. So can you see? So yes, it's still very risky downside, but don't forget that for this amount of naked puts, I reduce more than, I believe, 15, no, a little bit less. I believe it was 12 naked puts which I hold before. So instead of that 12 naked puts, I have right now just 5. So I reduce it more than 2 times. Plus I add short calls. So compared to my portfolio which I had before, it's much safer right now than it was before. This was idea for that move. Did I do it correctly? I mean, do I need to do it? I don't know. It was the first time when I do it this way, but we will see. I don't see any problem so far. And if volatility start going down and market going up, we will make huge profit. I will make huge profit from this position. It has pretty big potential. By the way, it's only 26. It was 26 days till expiration on Friday. So on Monday it will be 23 days till expiration. So theta is huge here. If we stay where we are or even go higher, that position start making very good money to me, and at some point probably I will close it. And if market cool down a little, I will go back to my my regular strategies like balalaika or violin or something else. By the way, I didn't close all of them. I still use some position of violin, CDHs you can see. I have kazoo, income 9, so I have some positions still old style, but I just reduce a lot of them this time because I'm not sure how market gonna behave next week. Next question is, once you have gone through a large enough downturn to have to roll most or all of your positions, how do you restart your income machine, assuming you have buying power? Do you restart back at 30 DTE or wait until the ladder expires out, start new violins? Yes, we will do the same thing. I consider that market get back to normal when volatility VIX will go below 20 for sure. I prefer that it will go to some 15 area. So before that I will be in caution, probably try to keep my margin used as less as possible. But when it will be back to normal, we'll start to do the same thing. Yes, we will wait till our short puts will be time to roll or close. We will open new one. If you're talking about CDHs, well, yes, we will improve them as soon as we start getting credit from roll of naked puts, and we can use part of that credits to improve CDHs. And we will go the same normal condition as we do. We will add if it's kazoo, we will do it at 60 DTE, new positions all the time, and so on. So income machine will start and go and work again pretty fine. But for now, we need to be in a little bit in caution. Okay, the third question from Daniel. At some point, a bounce will come and we will see higher prices in the short term. I would be interested to know how you are preparing for the next sell down. It's a very good question, Daniel. Yes, I always do it. If market is down in general and I see a bounce up, I just start at that point to evaluate all my hedges and try to improve some of them. If it's CDH, for example, you can roll down. The perfect way to close some shorts. But if it's too expensive, probably it will be expensive because volatility is still high. You can at least roll down your shorts of your CDH. If it's vertical, the same thing. You can close. If it's expensive, just roll shorts down. If it's delta hedge, the same thing. Just roll down your shorts. I don't think it's a good idea to roll up longs because they're too expensive. Our goal in this case to do as much improvement as possible at less possible price. So in this case, probably better will be roll down shorts instead of roll up longs of our hedges. This is how I usually do. So and I did, by the way, on Friday as well at the end of the day with my portfolio. Next question from Tom. Can you go into more details on the small kazoo strategy for large account? It sounds very interesting to me as a way to simplify my life. Yes, guys, if you remember when I introduced kazoo strategy, I tried to make them as simple as possible from a point of view that we don't need to do any rolls of that position. We just, if it was a mechanical, it is mechanical strategy. So if our deltas reached, we just close them and reopen new one. but it could be played the same way, little bit more complicated way as we do all other our strategies. I mean by rolling, and it's pretty safe in this kind of environment for sure because we have same amount of longs and shorts. How I recommend to play that, I tested myself. I like it how it's behave. So let's say you open five longs and five shorts. If market go down and it's time to roll out your short puts when they reach delta 20, you don't need to roll down your longs, you just need to close one of them. So you have five of them, you close one, it will be four left longs, and when you close that one long, you use that credit to roll down your naked puts. Next roll, if it's necessary, it will be even better because your longs, four longs, will be already even higher and closer to the market. So it's mean that they will be much more expensive. We will do again. We will close one long, and it will be three left, and use that credit to roll out naked puts. The same way it can be played if market going up. So we wait at least couple of weeks. If market, if your position negative delta, market went up, your position become negative delta, we can close one of longs and make it 4 to 5, and so on. Wait another probably couple of weeks, and we can close one more. So this way, but I wouldn't like to go to ratio less than 3 to 5 in case of market going up. If market going down and we don't have much choice, we can go to ratio 2 longs, 5 shorts. After that, I probably will start rolling down our longs to finance our rolls of our shorts. That's how I will play it. But yes, it's very flexible trade. Just I think you can try it and you will like it. And from Eagle Eye, for inks trades, are we going back to vertical hedges due to the current market condition and high VIX from CDH? Also, what the plan for 3 CDHs we have open at the moment in the model portfolio? I already answered partially on this question. We don't need to do anything with our existing CDHs. Yes, they are not perfect hedges because we didn't improve them, but it's still some kind of hedge. And don't forget, we open it for zero cost. We continue to hold them at least until our shorts of CDH will be at 30 DTE. After that, we can close them. But right now, we can hold them. They will help us maybe a little if market continue to go down. And do we need to start using vertical hedges? Yes, we had to use vertical hedges even before. If you remember, it was a plan that we open CDH for free, but use that credit, which we partially, 50% of credit, which we receive from rolling our naked puts. You have to go somewhere and improve. In our case, because we didn't have old CDHs at that time, we opened verticals, and we can continue to do the same thing. So continue. If we open new position, you should improve CDH, existing CDH, or open vertical. It doesn't matter. Both of them gonna work the same way for protection of our portfolio. That's it, guys. Thank you very much. Have a good weekend. It's already Sunday. I plan to do that video on Saturday, but unfortunately Optionnet Explorer didn't update database for Friday data. They did it just on Sunday, so it wasn't possible. It's already here 8 p.m. so not too many hours left till market, at least futures market will start up. We will see how it's gonna play next week. I hope we will do well. And again, guys, if you have a chance, try to reduce your positions right now, at least margin wise, and try to keep amount of naked puts in your total portfolio an acceptable safe level. Thank you very much again. Bye bye.